pleasure to introduce our keynote speaker this evening, David Rosenberg, of course. And for so many years, he has been good enough and kind enough to join us on BNN Bloomberg. And I must say, we anchors always were vying and competing for him to be on our show. It was always a very big deal to have him in the newsroom and to be able to interview him, get his thoughts for our viewers who, you know, I always think of as clients, having been on Wall Street for so many years, and the importance of sharing incredible insights with our viewers, with Canadians who don't necessarily have access to him like we do tonight, to be able to hear him firsthand, hear his thoughts, and to be able to ask him questions. So with that said, let me introduce David Rosenberg. He is the founder and president of Rosenberg Research, an economic and financial market consulting firm, which he established in January of 2020. He provides advice to 2,600 clients, both retail and institutional, in 40 countries. Prior to starting his own company, David was a chief economist and strategist at Gluskin Sheff & Associates. That was from 2009 to 2019. And prior to that, from 2000 to 2009, he was at Merrill Lynch, where for the first 2 years, he was chief Canadian economist and strategist based out of Toronto. And then for the last 7 years, he was the chief North American economist at Merrill Lynch in New York, where he was constantly ranked in the top 3 of Wall Street economists polled by the annual and most important Institutional Investor Survey. David is a frequent contributor to most major financial newspapers and publications in North America and makes regular TV appearances in the financial media. He received both his BA and MA in economics from the University of Toronto. Please welcome David Rosenberg.
Well, thanks, Catherine, and it's great to be here. I just want to say January 2020, starting a new business. No one ever said timing was my strong suit. Let me just say that actually this is a momentous occasion for me because this is the first time in 27 months that I'm giving a speech without wearing sweatpants. If I seem nervous up here, you're damn right I'm nervous. I'm nervous that if I exhale, I'm going to pop a button on my trousers. Now, I just want to say that I think that the organizers made a very big mistake closing the bar when I'm speaking. That has never happened before. And you will want to have a drink, and all those bulls that won their awards up here, congratulations, you're going to want to open up your umbrella pretty soon. So, you know, the title of this slideshow is Soft Now, Hard Later, and I'm asking all of you to get your mind out of the gutter. I am not the Pfizer analyst. We're talking about soft landings and hard landings. And it's been a fun 3 years, you know, with the Powell pivot. And the Fed has eased policy each of the past 3 years. And you should know if you're managing equities that in the past 3 years, the S&P 500 has practically doubled. And 70% of that increase came from the expansion of the multiple. Only 30% came from actual earnings, from earnings growth. And what we know about the power of the multiple versus earnings growth is the multiple is so important, it's 5 times, basis point for basis point, more powerful than earnings growth is. And if you switch, we mean revert from 70-30 to 30-70 on this relationship between the multiple and earnings, the S&P would actually be at 3,600 right now, which is where actually I think we're going to be heading. And if it gets to be a bad recession, it could be worse than that. And I think we're actually in the early stages of a bear market. And we've always had a bear market and a recession, and I really would like to have somebody talk me out of this view And I'll show you the evidence because we have this pernicious inflation on our hands. And of course, the chart was up there before. How could Jay Powell talk about transitory, but how could anybody have known that at this stage, China's case count would be worse than it was when the pandemic started? And they're closing cities of 15, 20 million every single week. They have almost 400 million people now under some sort of a lockdown. And most of them live in these port cities that are central to the manufacturing global supply chain. And that's creating massive cost-push inflation. This is not really about demand anymore. It's cost-push inflation. And then we've taken, Russia and Ukraine are two of the biggest commodity suppliers, especially in food and fuels and fertilizer. And so we've got this massive, if I was to draw you as an economic professor, I was to draw you what's happening with the global aggregate supply curve. As I sound like a boring professor, it continues to shift to the left. And there's no way anybody could predict this a year ago. And so, Jay Powell is not Christine Lagarde. He's not the Bank of Japan. The Fed is panicking. The Fed has become extremely hawkish. But I'm just going to posit to you folks that the only way we're going to crush this sort of inflation, which is about an inelastic supply curve continuously shifting to the left, is as a central banker, you have to shift the demand curve to the left. And they will kill inflation, but they will crush demand. Who cares what Jay Powell, who is the nation's economic cheerleader, says in a quote about, he's hopeful there's not going to be a recession, but there most likely is going to be a recession. And what I like to do is I like to dig into the sages and find out what they're saying so that I can delve into this period of uncertainty. So who better than Alfred E. Newman? I mean, come on. What, me worry? I mean, if you're not worried right now, I'm always worried. But if you're not worried and you're managing money for a living, you should find something else to do. So there's plenty to be worried about. I'm worried. I'm worried principally that the Fed and the Bank Canada, with their rose-colored glasses and their quest to kill cost-push inflation so aggressively, that they're going to push the economy into what I think is going to be an unnecessary recession. That is the principal risk. That is not just the principal risk, that's my base case scenario. Warren Buffett, what we learn from history is that people don't learn from history. And I think about that a lot, especially in the context of what's happening with this Russian invasion of the Ukraine and the law of unintended consequences. And you think of World War I, you think of World War II, first shooting war in Europe in 60 years. And there will be unintended consequences coming out of this. One of the things I think that we have to deal with is what will the world look like, even when this war ends, and it's going to end, is that Russia will be shut out of the world order. Whatever we want to define the world order, Russia is going to be shut out. Russia's a small country. It's a nuclear power, but it produces a tremendous amount of commodities. And so does the Ukraine, as we're finding out with fertilizer alone and the impact that's having on food inflation. And then we've got Baron Nathan Rothschild, who was the smartest and wealthiest of the Rothschild boys, who said, I never buy at the bottom and always sell too soon. He otherwise was saying, I play the middle 60%, I don't time the market. And what about Sir John Templeton? Bull markets born on pessimism, grow on skepticism, mature on optimism, die on euphoria. And I love that, because that is exactly what happened at the tail end of last year and the early part of this year as the market was hitting its all-time highs. Herb Stein. Remember Herb Stein? He was an economist, very famous economist in the Nixon administration. You know who his son is, right? Ben Stein? Bueller? Remember him? If something can't go on forever, it will stop. And as I read that, I think about this inflation. This inflation we're in is definitely going to stop. I'm not going to say it's transitory. Transitory never had a time definition anyways. If you're in team transitory, you're looked at like you're a leper. Okay, I guess I've got leprosy. Whoever put a time definition on it? If something can't go on forever, it will stop. And then the best of all, my favorite, I am a New York Yankee fan, don't hold it against me. It's tough making decisions, especially about the future. And that is a message to all forecasters. This is a forecasting dinner, although I'm not going to forecast anything. But it's a message here to always be humble, especially in my profession. My hero, and what I adhere to, is Bob Farrell, who was the Dean of Research at Merrill Lynch for 6 decades. He's actually coming on next week on my webcast. Show of hands who knows who Bob Farrell is. Nobody knows who Bob Farrell is? Not one person. Is there a person? This guy's a living legend. If you Google Bob Farrell's 10 market rules to remember, these are the 10 commandments. I'm going to sound a little preachy here. As successful as you folks have been, there's not a snowball's chance in hell that you would have been as successful if you adhered to the principles of the Dean of Wall Street Research, Merrill Lynch. I had the great opportunity to work with this guy for a couple of years when I moved to New York. He's retired now, but he's still sage, wisdom, experience. He's coming on my call. He's in his 80s now. These 10 market rules to remember, I actually just wrote a report about 4 months ago on an economics interpretation of Bob Farrell's 10 market rules to remember. I'm happy to send it off to anybody who wants to read it. Mean reversion, rule number 1. There are no new eras. Excesses are never permanent. Rule number 3. Rule number 4, exponentially rapidly rising or falling markets go further than you think, as the stock market did. And congratulations to the people that actually picked the bubble peak, came very close, but they don't correct by going sideways. This is the nature and the history of the markets. Number 9, when all the experts and forecasts agree something else is going to happen, and this overwhelming notion that we're in a permanent economic expansion here, that there's dry powder on household balance sheets that are going to keep the economy chugging along, which I don't believe, and that the central banks will achieve a soft landing. That is what a lot of people I talk to seem to believe. Now here's what I'm seeing based on the data. We are late cycle. I get this all the time. What's the question? Where are we in this cycle? I tell people we're in the 8th inning of this cycle. They look at me like I'm crazy because they're saying, well, the expansion ended over 2 years ago. You're telling me that this expansion, the recession ended 2 years ago, this expansion, 2 years old, is in the 8th inning? How could that be? Well, it's not about time. It's about how are the various market and macro variables behaving. We did a whole report on this looking at everything in the markets and everything in the economy and how they're evolving. This cycle benchmarked against where they typically behave in other cycles. And believe it or not, these 17 variables are telling us in the aggregate that we are 82% of the way through this economic expansion. It has nothing to do with how long it is. It has to do with a whole bunch of other things. In turn, also capacity constraints. So if I'm doing the math correctly, and remember we had a double dip recession, we also had a short expansion back in 1981. And we had a double dip recession under a guy named Paul Volcker. I'll get to that in a second. I think we're going to have another double dip recession. So in just a matter of 2 years, we've clogged in so much growth and so much capacity constraint that our numbers are telling us if you're actually playing the averages. There's no such thing as a sure thing in this business, but we have to have a base case scenario and we have to play the odds. This is telling me that a recession is a likelihood sometime in the second half of the year. It's not there yet. We're late cycle. How do you want to be late cycle? Well, late cycle is you grab that umbrella. You don't have to open it up immediately. But we are late cycle, and here is late cycle investing. It means you want to shed as much cyclical exposure out of your equity portfolio as possible. You want to become defensive, whether that's utilities, pipelines, healthcare, consumer staples. This has all worked, by the way, in the early stage of a bear market. And in your fixed income portfolio, obviously treasuries and Canadas are getting killed, but in your credit portfolio, trade up in quality. That's what you want to do for probably the next 3 to 6 months before you want to take the umbrella out. Now, 2 of the most important indicators out of the 17 I showed you is the unemployment rate and the yield curve. Of course, the yield curve, when the yield curve flattens or inverts, the bulls will always say, ignore the yield curve. Then when we steepens, oh, we love the yield curve. You know, it's like, you know, look, it's just like that, right? We have bulls and bears in this crowd, right? We have bulls and bears. I'm apparently the perma bear. It's like the optimist and the pessimist, you know, they go for a cup of coffee. Okay? The optimist says to the pessimist, things can't possibly get any better. And the pessimist says, you know what? I think you're right. And that's basically what we're talking about here. And The yield curve is still a bellwether, and the St. Louis Fed did work on this a couple of years ago, showing the two most important cyclical indicators as to where we are. Out of those 17 is the unemployment rate. And here we are in Canada at a record low. In the US, we're at 3.6%, almost back to where we were before the last recession started. And the yield curve is basically flat as a pancake. Classic late cycle. And the St. Louis Fed did the work for us. They told us that when the yield curve flattens or inverts, and when the unemployment rate hits a cycle low, the runway is really short, 9 to 10 months. So either way you slice it, second half of the year, I think we're going to have an official recession. And people just don't want to believe it. But they never want to believe it when you make these calls before the recession. The time to turn maximum bullish is when the unemployment rate is at the cycle peak. When it's at the cycle peak, I mean, that's not great news for social workers, but for investors, when you're at the peak of unemployment, historically you have 70 months till the next recession. 70. Okay, when everybody is hiding under the table screaming double-digit unemployment. That was the time this past cycle to start going along the stock market. At these low levels of unemployment, you can argue great news for the proletariat and Main Street, but it's classic late cycle, my friends, classic late cycle. And if you don't agree with the yield curve because it's become this contentious debate, oh, Jay Powell says, I'm focused on the 3-month to 18-month. You have people in fixed income saying, no, I'm not focused on the nominal yield curve, I'm looking at the real yield curve. That hasn't inverted. If you don't like the yield curve, forget the yield curve. The stock market's already telling you this. Key segments of the stock market. People say to me, the stock market's hanging in so well. Yeah, energy, staples, utilities. What sort of market is it when utilities hit an all-time high last week? Healthcare. The only cyclical that is actually at a high is energy, and it's not because of demand. We know what the reason is. So if you don't like the yield curve, look at the consumer segments. Look at the retailing stocks, home furnishing, home building, consumer electronics. Go to the banks. The bank stocks are in a bear market. The wealth managers are in a bear market. There's key segments, especially that represent the 70% of the economy called the consumer, that are in either steep corrections or bear markets. The stock market actually, believe it or not, has the story right. I think the stock market actually has a story right more than the bond market does right now. Now look, we're living through this incredible period of time. Incredible as in horrible. Okay? And we've got this situation where the inflation is coming from principally energy, but energy feeds into everything. Energy feeds into food. Because energy feeds into fertilizer, feeds into the fuel that farmers need for their tractors. So everything feeds from energy. That's why the inflation really started from oil, and it's filtering out. It's not the only story. But you see, here's the problem for central banks. What are you going to do? What's the Fed or the Bank of Canada going to do? Do they know how to grow wheat? Right? Are they going to start drilling for oil? All the central banks can do is influence demand. They can't influence supply. But what I can tell you is this much, is that when the year-over-year percent change in food and energy together, keeping in mind this is a de facto tax. You can't substitute that quickly from energy and certainly from food. What are we going to do? Stop eating? But when you have an 8% year-over-year growth in food and energy together in the CPI, rest assured we've always had a recession. The cutoff point's more like 5%. I'm not going to say this is cut and dry. I've been in the business long enough to know that you don't put all your eggs in one basket, and there is no such thing as a sure thing. But let me tell you something. Everything I'm looking at is telling me we have to be braced for a period of economic contraction. And I think it's actually already starting. It just hasn't started necessarily yet on the spending side, but it's happened on the income side. So we talk about how tight the labor market is, and we're talking about how nominal wages are going up. But this is real income. This is real wages. Real wages have been negative 6 months in a row. And they're negative year on year. There's no wage price spiral. I hear this all the time. I'm selling all my bonds. Larry Summers says we're going to have a wage price spiral. Where's the wage price spiral? The wages are just getting clogged up. The prices are going up so much more. The little guy is getting more wages, but not nearly enough. And remember, recessions are not nominal. Recessions are real physical inputs. In the 1970s, we had 3 recessions. Not once did nominal GDP go down. Real GDP. This is representing 80% of national income called wages. And I show this to people who say, what recession? It's staring us in the face. You don't think that real income erosion is going to, with a lag, not lead to real erosion in consumer spending? It's already starting. And you can see that in the survey data, because the consumer in the United States, which represents 20% of global GDP, it's 70% of US GDP, I call it Consumerica. What's bigger than the US consumer? And they're telling you that buying conditions for big ticket durables, now a lot of this is because during the pandemic, I mean, how many more ovens and how many more dining room chairs and how many more swimming pools are you going to need? So there's been oversaturation in this market. But taking a look at these durable goods spending plans from the University of Michigan Index, we're down to levels that we last saw in 1980, which was the first of the double dip recession. I'm saying that we already had the first, we're going into the second. And then we got to layer on this shock that we're seeing, which is the Fed and the Bank Canada. I know I'm talking mostly about the US, but it's the same here. We had a pandemic shock, we got a war shock, we got a food shock, we got an energy shock, a massive inflation shock, and now the Fed's starting to raise rates. And let me just tell you, okay, now the bond market's selling off because of the expectations that the Fed's going to have to do more, because every Fed official is going in front of CNBC, or they're going in front of Bloomberg TV, and they're basically sending in their vote in proxy. Bullard says maybe we'll go 75 basis points. Well, the market's reacting to that, but rest assured that there's never been a Fed tightening cycle where there has not been a financial accident, okay? Where's it going to be this time? I don't know. Could be commercial real estate, could be residential real estate. But look at this chart. This is the expectations of what the Fed's going to do. The Fed, yeah, right, during transitory, nothing's priced in. Do you remember this time last year, the Fed's not supposed to raise rates till 2024. Now we got about a 3% funds rate priced in, 3%. And people say 3%, it's so low. It's not about the level of interest rates. People were saying that in the last cycle when Powell couldn't even get to 2.5, and then he had to pivot because the economy rolled over, the credit markets froze, stock market went down 20% in the fourth quarter of 2018 on a 2.5% funds rate, because it's not the level, it's the change. If there was ever an economist that did a regression on a level, on a change, or a change on a level, they would fail miserably. You regress change on change, level on level. Look at this chart. That is what's undone the bond market, is the expectation that the Fed's going to go to 3%. And then when you tack on what they're going to do with the balance sheet and quantitative tightening, you're talking about a 400 basis point increase in interest rates between the balance sheet and the funds rate, which takes us back to the sort of tightening that Paul Volcker unveiled back in the early 1980s. In fact, last month, in a response to Senator Shelby from Alabama, and it's a mid-year congressional testimony, what does Powell say? He says, I think Paul Volcker was one of the great public servants of the era. He says it twice, not once. Oh, so you see, he's not comparing himself to Arthur Burns or William Miller or even Alan Greenspan. No, no, no. Paul Volcker. Do you understand what I'm saying? Paul Volcker. If you are long the economy and you are long risk, with the central banker of the world comparing himself to Paul Volcker, I say to you, good luck. Because we see that Paul Volcker killed supply-side inflation. That was actually less complicated than we have today, because that was just oil. So he did it by precipitating a massive recession back-to-back, massive unemployment, big decline in GDP, and a 30% bear market in equities. So don't you find that it's a little bit of cognitive dissonance to be comparing himself to Paul Volcker, who ushered in double-dip recessions, and then say, oh, we're not going to have a recession. Give me a break. We're playing the odds here. I said before that there's never been a cycle that doesn't ultimately pull the rug from whatever the financial excess. People say there's no imbalances in the economy, but there are major imbalances in the market. Well, let's go back to 1950, the post-World War II experience. 14 Fed cycles of higher rates, 11 recessions. What am I missing? I don't know, that's more than an 80% chance. Is it just pure fluke or is there a pattern? And he's talking about Powell's a soft landing. Well, we had a soft landing in the mid-60s because around that time, when the Fed was hiking interest rates under McChesney Martin, you had LBJ with the Great Society ramping out massive fiscal stimulus. The deficit tripled in 2 years. No recession, fine. Soft landing in the early to mid-1980s. But what happened was that the Saudis turned on the spigots and oil prices went down 60%. Huge tax cut for the American consumer, soft landing. And then the mid-1990s, under Greenspan, remember Greenspan took the funds rate up 300 basis points from 3% to 6%, soft landing. Why? Well, because in 1995, this company called Netscape went public and ushered in the internet and all the wealth creation and productivity that came with that. So if you have a soft landing story, come and tell me what the fundamental positive shock is going to be. You know, I don't know, we toasted to peace before. Maybe it'll be peace, but you see, it's not that easy because Russia will be shut out for a long period of time, and that's an added complication. But let's just say, especially to this view, that the Fed is calling for no recession. What do you want them to say? And in fact, it's not what you want them to say. They may be the worst forecasters on the planet. They have 300 PhD economists. To show you what I do for fun, I went to the Green Book. You know, the Green Book, at every FOMC meeting, the Fed economic staff has the Green Book with the forecasts. I went to the month before the recessions, all the way back to 1969. This is what I do for fun. But I'm a perma-bear, so of course I would. So you can see that before the recession, they've never forecast a recession. They've never had a negative forecast on the eve when it's staring them in the face. Their average forecast for the coming year is 1.8 on the eve of the recession. You understand what I'm saying? And the average is negative 1.2. And then you're taking a look since Bernanke with this great idea to do the dot plots and to do these forecasts every quarter. How ridiculous. Look at their success rate. The one thing they control the funds rate. They control the funds rate. They get it right 37% of the time. On GDP, they get it right barely more than 15% of the time. So, you know, sometimes you got to fight the Fed. Here's what I'll say about the recession, tracing it through. First leg down is 10%. We got that. We got the first leg down 10% earlier this year. You get the reflexive rebound. Remember, that was one of Bob Farrell's rules. And then you go down 21%. The total bear market in a recession, and there has always been a bear market in a recession, necessary sufficient condition, you're down about 30%. And so far, we've done some work, but not enough. And when it comes to the bond market, the much maligned bond market, the bond market's selling off because of the Fed. But in a recession, the 10-year note yield goes down 150 basis points. So I'm forced to love the bond because I have a recession forecast. And even in those pernicious stagflation, horrible 1970s, in the periods where we had the recessions, even in the periods where inflation, God forbid, stayed so elevated, bond yields go down in recessions, even when inflation stays elevated. So I'm going to be buying the Treasury in this environment. So I talked about late cycle, what happens when you go into the actual recession, the recession bear market. This is what happens. This is what history tells you. This is Bob Farrell's rule number 1, staring you in the face. All the stuff on the left you don't want to own. In fact, the worst performer, I get asked all the time about emerging markets. Yes, emerging markets are markets that you cannot emerge from in an emergency. So the TSX, which has had a great run, but you see historically there is a demand component. Even though we're greening the world and there's a structural bid into commodities. Commodities are cyclical. Commodities typically go down in a recession. Canadian dollar goes down in a recession. Gold holds its value. But the stuff on the right, which is long bonds, You got to hold your nose right now because technically they're not trading well. High, dividend stocks with earnings visibility. Oh, that would include the Canadian banks. I like stuff that's been beaten up. So I like bonds, I like the banks. Vol typically picks up a lot in this sort of environment. Let me just finish off. I got a couple of minutes. Candy, how many? I'm on the 2-minute warning. 2-minute warning, 3 timeouts? Just 2-minute warning. Okay, so when I'm asked what keeps me up at night, it's this chart, okay? And the number is $45 trillion. Look at that chart on the left. Do you know what that is? It is the value of equities on U.S. household balance sheets. Divide by 10, the number is the same in Canada, 45 trillion. 10 years ago it was 14 trillion. It's tripled in a 10-year span. That has never happened before because nobody rebalanced this cycle. Nobody rebalanced. Diversification became as dirty a word as transitory. Don't you see FOMO, fear of missing out, TINA, there is no alternative. Oh, don't fight the Fed. The Fed has your back, but that movie's being rewound. And so you could see 38% of the overall asset mix, almost double the historical norm. What happens if we go in? Do you not see? People have been lured in, of course, through the Vanguard ETF and all the ETFs. If we go into a bear market, will there be panic? The household sector has never been this exposed to the equity market before. Never been this exposed. So yeah, I'm damn nervous. And this chart looks the same again in Canada, just that we have better and more up-to-date data in the United States. 19% year-over-year growth in home prices. This, of course, is yesterday's story. This is all predicated from the lagged effects of that low interest rate period. Equities, long-duration asset, very rate sensitive. Housing, nothing more long duration than that, very rate sensitive. That story is changing. It takes now 8 years of income to buy a single-family home in the United States. We're back to where we were back in 06 and 07 when we can admit that it was actually a housing bubble. And in Canada, those numbers are worse. It takes 12 months of income, 12 years of income to buy a single-family home. This is all created by this interest rate environment. And the one thing I'll just say is, this chart here, I'm rich, I'm poor. People talk about the strength of the balance sheet in the U.S. household sector. Well, of course the balance sheet is strong because it is so asset inflated. But this, ultimately, this is unsustainable right now. So you have to be wondering, if we get a mean reversion, Bob Furrow's rule number 1, in residential real estate, which is very possible, and equities, what will this chart look like 12 months from now? And then when you feed this back into how consumers will behave, very difficult for me to believe that we're not going to have another recession. The question is, how big will it be, how long it will last, and what the Fed's reaction function is going to be, which is not going to be what it was back in March 2020. People say to me all the time, and I'll finish off here, where is the Powell put? Where's the Powell put? Remember, there was coined the Greenspan put back in 1987, and all these central bankers had their different pain thresholds. We had the Powell pivot, the Powell put. Well, he's comparing himself to Paul Volcker. So I'll tell you what Paul Volcker's put was. You know what Paul Volcker's put was in August of 1982? You know what that put was? 8 on the P multiple, not 19. But I'm not a perma-bear. I'm just bearish right now. Anyway, thanks very much, folks.